Joining us now, Gabriela Santos, JPMorgan Asset Management Chief Market Strategist for the Americas. And just thinking about some of the things that you mentioned to our person that called you and begged you to come on this morning. The recent decline in yields sort of took off the table that 6 and 7% fear that we had. But that shouldn't mean that we're clear sailing either, because it could be here for a while. So unfortunately, equity investors, it's still all about what happens with interest rates.
Yes, unfortunately, it kind of all begins and ends with rates and the volatility in the yield curve. So I think what was helpful during the Fed meeting in November, during the Treasury refunding announcement that week, and with the jobs report, is that at least it took off the tail risk that yields could continue rising much, much higher. I think that was what was really paralyzing investors.
For good or for now?
I think for good, if you align with our projections, which is that inflation continues to moderate from here. We could be speaking by the end of the first quarter of headline CPI with a 2 handle, and then by the middle of next year, core CPI with a 2 handle. I also think in terms of the deficit and the interest cost discussion, there's a lot of that that's understood now. We got it. It's here to stay, but there's already a substantial risk premium embedded there in long end yield. So I do think at least taking off that tail risk was helpful. It allowed investors to come back in and take opportunities of more discounted valuations, but still for now pretty limited to long duration, kind of mega cap tech, weight loss drugs, still pretty concentrated. I think what will be more helpful is in the weeks ahead, in the couple of months ahead, when we actually start getting conviction of exactly how much are yields going to drift lower. And that all really is about a discussion of the Fed closing the door for good on further hikes and investors actually taking into account rate cuts in the years ahead.
So you're asset management chief market strategist. Does that mean at this point you would tell people, if you have young people that like the stock market, are you insisting they extend duration and buy some bonds? Ron Barron's never bought a bond. I think.
Oh, is that what he said?
Yep, that's what he said on Friday. He's never bought a bond.
I've never bought a bond.
Not one bond.
Can't you figure something out in the stock market that's going to do better than 5%?
That's his argument.
I just, if you're that afraid, that's what you need, a nightlight. If you go to bed every night, you need to keep the light on.
There are some people who need fixed income
you need,
as you get
but
older,
you can get the return of your money. I guess it's important. But when we see the Dow go from 800 to 30,000+.
And I will say Buffett basically says the same thing.
Yeah, I agree. 5%. That's the best you're going to get is 5%. And then if rates continue to go up, you're not even going to get that unless you wait till the end.
So I think if you think about the growth area of your portfolio, where you're really going to compound your wealth over time, that's absolutely going to be risk assets, of which equities is the main one.
But bonds are risky too.
Well, bonds have shown to have some higher volatility than we got used to there for 15 years or so, but they still have less volatility than stocks do.
Short term. A 30-year might not.
And if you think about actually the role that bonds play, it's about income. It's not about growth in the portfolio. And it's about, keeping investors invested in the stock market when you actually do get that 10% correction once a year or that 20% correction every once in a while. At least you have a little bit of a ballast somewhere else in the portfolio.
Right.
And not when it's about inflation fears, as we discovered last year, when it's about growth fears. And it's natural. We'll start at some point talking about a real recession fear again. So absolutely, the growth piece of the portfolio are stocks, are high yield bonds, or growth year bits. But we do still think you can have a decent role for bonds in income and some ballast in the portfolio. But the thing is, it's not cash, right? Which is where we see a lot of investors looking at the moment for that income, that ballast. Who knows where we'll be 6 months from now, 12 months from now. So really, the biggest risk we see next year and beyond, it's a reinvestment risk. And so there's a need to start extending a little bit the duration there to at least capture that income benefit for a little bit longer.